Time for the ETF report. We're joined now by Sean O'Hara, president of Pacer ETFs. Sean, thanks very much indeed for joining us.
Yes, good morning. Thanks for having me.
Tell us a bit about your company. What kind of assets do you have in ETFs right now?
We have about $40 billion in assets under management. We started 10 years ago, so we're on a pretty good growth trajectory, excuse me. And I think about 55 or 56 different ETFs at this point.
And are you just offering them in the US or any sold in Canada or issued in Canada?
We do not have anything on the Canadian exchange. However, we do have Canadians that buy our ETFs. As you know, they're allowed to purchase US listed products. Oh, yeah. And we do have a small usage platform based out of Dublin.
Oh, I see. That's for international clients or the one in Dublin?
Yes.
Oh, okay.
Well, a little bit of both. I mean, there's a lot of people in the U.S. who invest here from South America, Mexico, and places like that. And so it's sort of a dual accommodation thing there, some to satisfy those folks in markets like Miami, for example, and then the broader European opportunity.
Well, let's get into a couple of the products you have. This is an intriguing one. It's up about 44% in the past year. Symbol is PATN. That's the Pacer NASDAQ International Patent Leaders. That's an interesting concept. A lot of people saying that intellectual property is the most vital economic asset right now in the world.
Yeah, this is an ETF we developed sort of in tandem with the NASDAQ. So we have, a pretty robust partnership with them. We use their indexes in a lot of different ways. And we had gone to them and said, why don't you have a NASDAQ 100 for international? And they thought, well, wow, that's a really cool idea. And so we went through several iterations. What we tried to do initially was to say, like, let's find a U.S. company who has an international counterpart, if you will. So you say like Apple, Samsung, for example. And that really wasn't the correct path. And then they came back to us and said, what makes the NASDAQ is innovation. And what drives innovation is intellectual property and patents. Mm-hmm. And so they work with an organization, IPR, to identify the patent value of individual companies across the international spectrum. So we start with the NASDAQ, small and mid-cap international indexes, and then we apply that patent score, and we select 100 stocks with the highest patent value. And so for those, who've been talking about international investing, which has been, a pretty hot topic of late, this is dramatically and intentionally different than traditional broad-based international indexes. It has very little, if any, exposure to financials, as an example, although financials are about 20% of the benchmark. It has a very, very big overweight, as you would imagine, to technology. So if you want to invest internationally, one of the drawbacks of international investing has been that the broad indices earnings growth, because it's saddled with sort of these heavy industry financial companies, hasn't been very attractive. By taking it away from that sort of cap weighting and sector weighting approach and focusing on patent value, you're able to create a much more dynamic portfolio that are names that are going to have potentially better growth opportunities than just the broad-based international index names.
And I see Taiwan Semi's the biggest holding, according to the latest report I have. Then Tencent, the Chinese internet giant, and Samsung Electronics, and ASML, the Dutch chip technology company. I see Toyota is in there. And then you have a couple of three drug stocks, Novartis, Roche Holding, and AstraZeneca among the top 10.
Yes, and so that would be sort of, a pretty good look, right? You got the technology names, you got ASML, who's, their etching platform is basically second to none. And, these chip wars are going to continue, and there's going to be big demand there. You have a couple of healthcare companies that's mostly looking at their pipelines. And then Toyota's an interesting one because, they're also, beyond just a car manufacturer, they're also getting into robotics and things of that nature.
Let's get to your next one. It's the Pacer US Cash Cows 100 ETF, COWZ. What's the idea with this one?
Yeah, this one is sort of our take on quality or value. Traditional value has been really price to book and low price to book, and that sort of weds you to sort of the same heavy asset sectors like financials, utilities, real estate, and materials, for example. So we use free cash flow yield as a screen here. So we screen from the Russell 1000 index, the 100 companies with the highest free cash flow yield. And then we take those companies and we weight them by their free cash flow in dollars with a cap at 2%. We rebalance every 90 days. And for those who are thinking that we're going to move back into sort of a quality cycle, we've been in a very, very heavy momentum, low quality market for the last 2 years plus. So far out of the gate this year, and really for the last 90 days, Cows has outperformed the broad market, and if you measure it by the S&P 500, mostly because there's some skepticism, if you will, about valuations in the broad market. There's some skepticism that the hyperscalers who have committed to spend $3 to $5 trillion are actually going to monetize that. And so Cows gives you a high quality portfolio of 100 stocks that are profitable, that generate huge free cash flow. And over the life of the fund, we've beaten our value benchmark by around 300 basis points a year. So it's delivered quality returns consistently for investors. And in this environment, I think a little lean towards quality and profitability, given that the market has been so focused on momentum and 7 names, might be a good add-on in a portfolio.
It did lag the S&P 500 last year, a return of about 9%. So it didn't keep up with the market.
No, but as I said, the last 90 days, it's 600-700 basis points ahead of the broad market. So if it turns, and it will at some point, you'll see, that predominant pattern of Cows sort of moving forward when the broad market sort of, slows down a little bit.
And tell us about your last one. It's QDPL, Pacer ETFs, U.S. large cap dividend multiplier.
Yeah, so this is sort of our answer to how do you get income from an equity portfolio. So traditionally, people would use a covered call strategy, for example, or they might buy high dividend paying stocks. The trade-off you make when you do those kinds of things to get income is you sort of cap your upside, if you will, specifically with covered call strategies, like something like a JEPI, for example. What we do is we sort of deconstruct the S&P 500 here. We put about 85 to 90% of the money in the S&P 500, and the remainder is used to enter into futures contracts for dividends, which is how we generate that extra income. So we're targeting an income stream of about 4 times the S&P's dividend in a portfolio that's really uncapped on the upside because it's mostly invested in the S&P 500. And so if you're thinking about getting income from your equity portfolio, those traditional ways might not necessarily provide the same sort of, 1-2 punch, if you will. You're not constraining the equity returns, but you're also getting a very, very high yield. And most of that yield is tax-free.
Why tax-free?
Because from a tax perspective, they treat the dividend futures component and the collateral that we use as a return of capital. All dividends are basically return of capital, but if you get a normal dividend, the IRS decides they're going to tax that as a dividend. Here, because of the way the accounting works, we're able to sort of shift that burden. We continue to defer the taxes and classify some of the distributions as return of capital. So like last year, we made about 85% of the market's return on the equity side. We distributed around 5%, and I think 93% of it was tax-free.
Although my understanding, and we better caution viewers, talk to your own tax advisor whenever tax comes up, but a return of capital, I think, reduces your acquisition costs. So you can, in some cases, pay more in a capital gain when you sell it.
Not necessarily. If you hold it for your lifetime, you could get a stepped up in cost basis. But yes, at some point down the road, if you were to sell the ETF, you would pay tax on the undistributed gains.
No problem. And that one broadly matching the market last year, a total return of just over 16%, only slightly lagging the 18% return from the S&P 500. Fascinating stuff, Sean. Thank you very much indeed.
Thank you so much. Have a great day.
Sean O'Hara, president of Pacer ETFs.